This presentation will focus on the role of expansionary policies and preferential shares to drive up company valuations in an ultimately unsustainable way. The expansionary monetary policies which followed the 2008 financial crisis facilitated a sustained bull market through the 2010s. A pro-investor fiscal landscape combined with near-zero interest rates saw the stock market achieve sustained record highs through this period. The gulf between these two lines demonstrates this clearly. This coincided with rapidly growing valuations for many of the tech firms which have quickly become synonymous with modern society, despite some of these firms, such as Uber, struggling to produce a profit. A confluence of readily available funding, low interest rates and expansive startups saw a cycle emerge towards the end of the last decade, of tech firms and large startups focusing on hypergrowth and valuations, with a quick IPO the ultimate focus over achieving profitability. This IPO cycle continued, with companies increasingly using convertible preference shares and other favorable investment structures to drive up valuations in the near term with the goal of completing an IPO as quickly as possible. These favorable investor conditions were sometimes at the expense of original shareholders once converted, but with the sole goal of driving value towards an IPO. While this cycle created thousands of tech jobs and widespread shareholder value, it did lead to an unsustainable IPO bubble. Perhaps the company which most epitomized this timeframe was WeWork, whose charismatic CEO and his vague vision for a tech hybrid office saw a rushed race towards an IPO before deeper analysis revealed the major overvaluation. This signaled wider alarm bells and greater skepticism of IPOs to come. Just months after the WeWork fiasco, the outbreak of COVID-19 saw governments globally accelerate expansionary fiscal policies and inject unprecedented levels of liquidity into the economy to counter the lockdowns and associated shocks. As well-intentioned as they were in response to emergency, these policies exacerbated the IPO bubble, and despite the cautionary tale of WeWork in late 2019, the cheap money available to investors through the pandemic was taken full advantage of, with a record number of IPOs in 2021. Especially those performed via the use of SPAC investment vehicles. As the quote says, however, there is no such thing as a free lunch. 2022 saw the end of COVID policies and a reopening of economies worldwide. As some predicted, this was not a smooth process. The past 18 months have seen rapid inflation which was countered with sustained interest rate hikes. Naturally, this has quelled investor appetite, leading to far fewer IPOs, rapidly falling tech values and much greater selectivity from investors. The IPO bubble has well and truly burst, but it leaves behind lessons on the importance of organic growth and creating sustained value versus pumping valuations as fast as possible to achieve an IPO. Further study of private equity and other forms of financing will inform our understanding of this sector, but it is clear from review of the recent IPO bubble the risks associated with focusing on growth over profitability.